The next 2 hours can literally make or break the crypto market. Hello, everyone. This is not a catchy headline or clickbait. This is one of the most dangerous and macro dense weeks we have seen in months. We are talking about a moment where everything lines up at the same time. And when that happens, markets don't move randomly, they move violently. This is not a live stream like others. We are in the middle of a perfect macro storm where politics, central bank, inflation, earnings, and liquidity are colliding at once.
Yes, that was very good. And yeah, hello
Good
everyone. Hello,
intro.
Rafa. Yeah, I'm
Hello,
also here.
everyone. Hello,
Don't
everyone.
forget about me. Yeah, I actually totally agree with everything that you said. Yeah, but yeah, need to add as well that this is the kind of environment where one sentence, one word, or one change in tone can shift billions in capital within minutes. Yeah, and that's Powell. Yeah, am I right?
Oh, oh yeah. In less than 2 hours, markets will have to digest several major events at the same time. First, the Federal Reserve decision, then, much more importantly, the words of Jerome Powell, and that is just the beginning because after that we will also get Trump's speech, big tech earnings, fresh inflation data, and the looming threat of a government shutdown. So a very busy week, Dimitro.
Yeah, I agree with you. This is not a normal trading day. You need to, I mean, everyone need to understand that. This is actually a stress test for the entire financial system, and we will see how we are traders. Yeah, go through that.
Oh yeah, we are already seeing some very abnormal move in the market, especially for precious metals.
Yeah.
Today we are not just looking at charts or indicators. Today we are trying to understand something much deeper. Who actually controls the market right now? Because this is one of those weeks where trading blindly without macro awareness is extremely dangerous.
Yeah, exactly. And moreover, we have inflation that is overall stable even with tariffs. Central banks under heavy political pressure, and yeah, equity markets that are already stretched, and of course, a crypto market that depends almost entirely on marginal liquidity. So, in total, that combination is actually extremely fragile.
Extremely fragile, right word. Here is the key point everyone needs to understand. The market is not waiting for the rate decision because everyone expect no rate cut today. The market is waiting for Powell's message. The Fed fund rates will, as I say, almost remain unchanged, and that is not the story. The story, the real move starts when Powell begins to speak. That is when expectations shift, liquidity reprices, and risk assets react. Rates are static, narrative are not, and market always follow narrative. And of course, Trump will then speak about the US economy growth, energy, and prices. And this is extremely delicate because if Trump pushes for lower energy prices, higher growth, and more aggressive policies, he is indirectly attacking the Fed's inflation narrative.
Yeah, that's right. And this is actually where it gets serious. Trump hasn't just criticized Powell in the past, and yeah, he even has attacked him directly and publicly. Yeah, so he has questioned his decision, accused the Fed of damaging the economy, and openly pushed for his replacement. So, Rafa, tell me, is this is like a fight between Trump and Fed, or what?
Trump versus all the world. Trump is
Yeah,
trying to fight the world, and also inside the inside government. So a quite crazy president, and all of this is happening while Powell's mandate is approaching to its end. So this is no longer a theoretical or ideological debate. This
Yeah.
is a direct power struggle between the government and the U.S. government and the central bank.
Yeah, and what makes this even more important is that Powell, something extremely rare, has already responded directly to Trump in a scheduled video, defending the defending the Fed independence. So I would say that is very strong and very unusual signal, actually.
Yeah, in my life I have never seen a kind of
Yeah.
such a video from like the chief of the most powerful central bank in the world. So uh, guys, time is quite weird these
Yeah.
days. So the real question tonight is there is only one real question: will Powell use the FOMC as a stage to respond to Trump? Because this is where the short-term destiny of the market is decided. Let's be very clear about what will not happen tonight. There will be no rate cuts, of course, and there will be no rate cuts again.
Yeah.
And rate hikes as well.
Yeah, of course. And Rafa, what do you think if really Powell decide to respond to Trump? How market will be affected by that move? What do you think?
I think that will be a very bad sign for the market, because market always wants a stable policy.
Situation. Yeah.
Yeah, stable situation. So something that is very nervous and it's showing fragile sentiment, and a battle between the government and the central bank is the worst scenario ever. So I hope Powell is serious and very controlled man. So I think he will not um, fall into Trump trap, but I'm not sure. Let's see, because as I just say, he is going to be replaced soon. So everything is possible. Everything
Yeah,
is
and
possible.
if like in any case, if emotions will take him over, like that gonna be really, as you said, worst scenario. Yeah, because we
Mhm.
can expect anything actually. Yeah, because market can be very manipulative with that, like with that situation. Yeah, we can just remember even like one post from Elon Trump, from Elon Musk, Elon Trump. Oh my god, you know. Yeah. So and yeah, overall we can say that what matters is, of course, language, tone, forward guidance, and how Powell react to inflation and tariffs. So yeah, we will see
Yeah,
what's gonna happen.
yeah. According to BALS data, inflation right now does not show a clear cooling trend, and at the same time, Trump is talking about new tariffs. So, tariff are imported inflation, and inflation means a more cautious Fed, a more hawkish Fed, and less liquidity. And when liquidity tightens, risk on assets suffer first. But right now, inflation is under control, but everything depends on the next Trump move. So the classic scenario is like the one well known: an initial spike, a fake breakout, and then a violent bar style reversal. If Powell downplays inflation, we could see a rally. If it stays hawkish, pressure will hit the entire risk on complex.
Yeah, and what we need to remember that in moments like this, Bitcoin does not lead the market. Actually, yeah. In this scenario situation, we can say that Bitcoin actually follows liquidity, and we just need
Yeah,
to see, yeah, where liquidity will move after like every single word of Powell, yeah, of his tone and all that stuff. So yeah, let's see.
yeah, oh yeah. Now let's address the question many people avoid. Why are crypto markets suffering so much? Dimitro, they are suffering as crazy compared to other assets.
Yeah.
If we look at the macro context, rates will eventually have to come down. The dollar is at roughly 4-year lows. Global liquidity is increasing, and quantitative easing keeps growing month after month. So, in theory, Dimitro, what does it mean?
Yeah, in theory, this should be the like perfect environment for Bitcoin and in overall crypto. And yet, what we see is actually structural weakness. So Riley is being sold, no real enthusiasm for now, and persistent negative sentiment. So the problem is not macro, the problem is deeper. But how deeper is that, Rafa?
Is very, very deep because my personal view is that the crypto market never truly recovered from the October flash crash,
Yeah.
an event almost no one talks about anymore, but one of the most violent crashes ever. We saw over 19-20 billion dollars liquidated in just one day, cascading forced liquidations and retail accounts wipe out in minutes. So this was not a normal drawdown. This was a market trauma that has not recovered yet.
Yeah, it was actually a big flash crash because yeah, even some stop losses didn't work. Yeah, because there was
Oh
no
yeah,
liquidity. I mean, there was one of the biggest, if not biggest, yeah, we can say,
yeah.
because big wipe in like few minutes, hours. Oh my god! And yeah, when a market experience trauma like this, confidence does not like return quickly, of course. So leverage disappears and sentiment remains fragile. So yeah, a lot of people, even I would say, even like scare. What do you think, Rafa? Some people really
Yeah,
scared
yeah,
about trading
yeah.
crypto
They
after
are
that.
totally, yeah, they are totally scared, and they lost through on Bitcoin. So they are just giving up, and because their portfolio and balance just wipe out in one day. And since October, the crypto market has never rebuilt trust. So every rally gets sold, enthusiasm never came back, and this explains much of what we are seeing today.
Yeah, and while that's happening, capital is quietly rotating elsewhere into precious metals, resilient stock, and value protection assets. So, because those markets don't carry recent trauma.
Yeah, yeah, there was not a liquidity problem or flash crash like
Yeah.
in crypto. So crypto are still in a healing phase, and confidence hasn't returned. So large capital is not in a rush. Until the market full forgets October, crypto will remain behind, even with a favorable macro backdrop and macro scenario as now. Okay, so we are on the decision imminent, guys.
Yeah,
Dimitro, yeah, let's put some volume up.
of course.
Basis point. As we kept saying, the drama, the fireworks, and headlines have been in the FX market, with the dollar trading very close to multi-year lows. A Fed decision seconds away, unchanged as the expectation. With the call is Mike McKee.
Well, pretty much as expected, John. No change in rates, and the Fed leaves open the option of cutting rates in the future. Stephen Myron and Chris Waller dissent in favor of a rate cut. Michelle Bowman does not. Waller's dissent, of course, could be read as an effort to retain his place as a finalist to replace Jay Powell later this year. The statement keeps the line about considering the extent and timing of additional adjustments to the target range, suggesting more rate cuts are possible. There's no hint, however, of what that would lead them to do that or when. The economic assessment is very short and relative to recent statements, slightly positive. Available indicators suggest that economic activity has been expanding at a solid pace, it says. Job gains have remained low, and the unemployment rate has shown some signs of stabilization. Inflation remains somewhat elevated. The officials say uncertainty about the economic outlook remains elevated, but they don't emphasize jobs, as they have the last three statements, or inflation as the major concern. The committee is attentive to the risks to both sides of its dual mandate, the statement says. The open market desk at the New York Fed is again told to maintain an ample level of reserves by buying treasury bills or, if necessary, maturities of up to 3 years or less. It's all about as plain vanilla as you can get, which shifts the focus, of course, to Chairman Powell's news conference at the bottom of the hour. What does he say about the future of interest rates? And what does he say about his future as a member of the Fed? Stay tuned.
Mike McKee, we will stay tuned. The news conference about 28 minutes away. You run into that. Mike McKee there, world class as always. A Fed decision, unchanged. The vote, interesting, 10-2 to hold rates steady. The two, Governor Myron and Governor Waller. TK, is it unfair to describe the Governor Waller dissent as an audition to take the top job at the Federal Reserve?
1991 is classic paper on game theory. I just think we saw a little Waller game theory going on, to say the least. I don't have a strong opinion on it, but definitely that's a setup for the president to make a Waller decision.
This has been an individual, Torsten, who has provided thought leadership on this committee, effective thought leadership now for a number of years. That dissent will be described by many in this market as an audition for the top job at the Federal Reserve. Is that unfair?
I think it is a bit unfair. I mean, Chris is very, very steady and stable and has had his whole career as a PhD economist doing research, going after the data, being data dependent. So I do view this mainly as a sign that he actually is worried. And his speeches have also given very clear indication of this. He is actually truly worried about that the labor market might be signaling that things are about to get worse. So I think it's a little bit unfair to put him into that category, because I do think that it's very important that he is telling us that he does believe that rates should have been cut today.
Is that worry about the jobs market justified by the data you look at?
Well, that's the discussion. I happen to have the view that this is all because of labor supply being much lower. Immigration used to be 3 million a year. Now it's about 400,000 from the CBO. So if labor supply is lower, you should also expect job growth to be lower. Other people, including Chris, put more weight on labor demand. So that's the debate at the moment. Yes, there has been very little hiring, very little firing, suggesting that labor demand is indeed also weak. So this is the very important debate. And of course, only the data over the next several months will tell whether this dissent was actually a good idea or not.
John, for the press conference and for Vice Chairman Clarida, Fed omits language on downside risks to employment having risen. Let's have a chat with some Amazon people this morning.
Yes.
Let's talk to UBS this morning. The mail I get, the mail you get. People think fancy guys like Torsten Slack are nuts when they talk about a fully employed America.
I don't want to overdo the data that comes from the conference board, because consumers' confidence all over the place right now is skewed by a whole bunch of things, including politics. But attitudes.
All right, guys. So as expected, no rate cuts, no rate change. Only 2 members of the board voted for a cut, and the other 10 just kept it for 3.75%. As we can see, they just mentioned that the US economy is still resilient, so they don't need and they are not in rush to cut rates. Bitcoin is basically flat. Dollar index is rising as a hell. And let me also have a look on the yields. Treasury yields, they are not rising that much. So the first big reaction we clearly see is on the dollar index. Crypto, of course, are still basically flat. Dimitro, you want to comment something, or you want to share your thought? Yeah.
I'm just actually, yeah, I'm just waiting for Powell's speech. I think I I just really want to see that because yeah, I
Yeah,
mean
yeah, yeah.
we expected that, yeah, for
Yeah,
for
sure,
the
sure.
right?
Yeah, yeah. So, just
Nothing
I'm
major
quite,
still.
yeah, just quite surprised that the vote is not like 100% on agreement. But yeah, of course, Powell will decide the mood of tonight. So
Oh,
everything.
it wasn't 100, yeah, 100. Oh, okay, okay.
No, I mean, 10 members vote for no change, and 2 members vote for rate cuts of 25 base points. So there is a big, like, small conflict inside the Fed, but I guess that 2 members are close to Trump, so they are trying to, mess up a bit the vote. But any case, in general, they all agree about the no change on the rate cut. So yeah, let's wait for Powell. Bitcoin is dropping a bit, as we can also see from the order book. Is not really active. I mean, just a
Yeah,
few volume, and of course, Powell will bring some volatility. So, guys, we
yeah,
are
we
just
wait
at
that. Yeah.
the yeah, we are just at the beginning, and let's wait 23 minutes. Let's enjoy some comments and analysis, and we'll get back soon.
Yeah.
The last hike, which was all the way back in 23, or the first cut in 2024, the 10-year Treasury has been in a range from roughly 4.75 to 3.75. A lot's happened in that intervening period. That importantly reflects much higher real rates than we had pre-pandemic. So you have seen a shift up in the curve relative to pre-pandemic. And yes, would expect the curve to continue to steepen over time as 10 years stay in that range and as front-end rates come down under the new chair.
Rich, as you identify a range, impressively stable so far. For you and the team at PIMCO, Rich, what's the biggest pillar of their stability that we've seen over the past few months at the long end of the curve?
Well, I think it reflects the new dynamics, both because potentially of faster productivity growth and fiscal concerns. It's appropriate that longer dated real yields are higher than they were before. I think that's an important fact of life. I mean, the real debate and the real issue is, within the Fed and in the markets is, where's the neutral rate? Where do front end rates end up? And we still think that neutral for the funds rate is somewhere down around 3%. But obviously that's going to depend on where we are in the cycle as well.
And this may be an unfair question, Rich, but I mean, do you think an incoming Fed chair is going to make dramatic changes to the Fed staff in terms of who's head of which departments? Or how do you think the incoming chair might think about things if he or she doesn't think that it's likely that interest rates are going to be coming down because of persuading the committee?
I'm not sure about that. It is important just for the public to know that the board staff does report to the chair. During my time there, Chair Powell asked me to get very much involved with the staff, and I learned a lot from them. But I think there typically have been and always will be changes in staff. People get promoted, people moved on. And I should say, during my time at the Fed, the senior staff I worked with was incredibly capable. So I don't think there'll be any issues there.
First and second, I think it's so important that we describe the academics of Richard Clarida, all that he did with his fancy thing, dynamic stochastic general equilibrium theory and monetary policy. John mentioned earlier, do we know the reaction functions? Do you have an operative theory from the world of Richard Clarida now? It's operational.
Well, Rich is well famous for the credit multiplier and the work he did with Bernanke. And of course, what credit markets have been doing and what credit markets are doing is often very critical, of course, for the economy. Because if credit conditions begin to tighten, the economy has a problem. If credit conditions begin to loosen, of course, the economy could also have a problem, namely that it just becomes too easy money, including in credit markets.
And Jack, conversation after conversation, the assumption is credit markets are going to loosen because we have, maybe it's Biden-like stimulus. I believe the next 6 months we're full bore ahead.
The credit spreads are very tight, and now the dollar's weakening. And when you think about the dollar's influence on financial conditions more broadly, Torsten, what is the contribution that comes through the FX channel?
Well, what I think is very important to remember is that foreigners come to the US for two reasons. They come to cut coupons in fixed income because yield levels are higher here, and they come to get exposure to AI. So for any discussion, for talks about, well, will the dollar begin to go down, you need to come with a view that either AI is going to roll over or interest rates are going to be a lot lower. So as long as you can cut coupons and get much higher returns in US assets, you will still have foreigners abroad in Europe, Japan, Canada, Australia, who come to the US to buy US financial assets because they simply do offer higher returns than what you get in most other countries.
Foreign holdings of treasuries at the end of last year, close to the end of last year, record highs. People hardly talk about that today.
Well, and if you go back and look at the tick data for net foreign purchases of U.S. assets, you saw that in April of last year during Liberation Day, things were absolutely chaotic. It was indeed the case that the rest of the world was sell America. But since April, for the data we now have from May up until November, it was very, very strong inflow of data into rates, in particular credit, and also, of course, into equities.
If you are just tuning in, welcome to the program. About 10 minutes ago, the Federal Reserve leading interest rates unchanged. 2 votes for a 25 basis point reduction from Governor Waller and from Governor Meyer. A news conference with Chairman Powell in about 20 minutes' time. We've got the former Fed Vice Chair, Richard Clarida, standing by just for one more question. Richard, I want to come to you on this, an important topic, because the Chairman will be asked about this in the news conference. I have no doubt of that. A more confrontational approach, a more assertive approach from the Chairman a few weekends ago towards the White House. Rich, what do you think prompted that? How much internal debate was there about it?
You know, I'm not sure. I guess we'll have to wait for Jay Powell's memoir to find out. I just infer that the chair made the decision. He had been quiet and had really not weighed in the past, and I think he just made a decision that he wanted it to be known that he felt that the Fed needed to focus on independence and focus on making the judgments on monetary policy.
Do you think that's made it harder?
Any color beyond that, we'll have to wait for the memoir.
Rich, do you think it's made it harder to focus on monetary policy, though?
I really don't. I don't think so. In light of all the things that are going on, I think it was a very clear indication that for the remainder of his term as chair, that will be the focus.
Richard Clarida, thank you, sir. As always, the former Fed Vice Chair, Rich Clarida. We have no doubt the Chairman will be asked about that issue in about 20 minutes' time. Joining us now to extend the conversation, Bob Michael of JP Morgan Asset Management. Bob, you've always got your own questions, buddy. What do you want to hear from the Chairman in the next hour?
Well, the question he's not going to answer is, does he intend to stay on after his chair expires? But I think the one to ask is, what does he see in the labor market that's particularly wearing to him? And is the Fed undergoing studies about what the broader impact of AI will be across the economy?
Bob Michael, you look at the key question that you mentioned is labor. We mentioned this earlier off Orzag and Posen recently. Does your team at JP Morgan see any form of wage dynamic that indicates inflation?
Not so much right now. I think this low hire, low fire has really dampened wage gains quite a bit. We'll see what happens in the first half of the year.
Yeah.
Certainly expectations are pretty good for the economy and corporate spending. Maybe that will lead to higher wages, but right now you're not seeing evidence of that.
I really can't emphasize enough, folks, that phrase there, to see into the middle of the year. Then, Bob Michael, with that, with an interest rate strategy and given all the upset at the Fed, how far out is the Bob Michael vision at JP Morgan? Can you get out to Q3, or dare I say, model out a fixed income portfolio to 2027?
You can, and you have to. You can't invest a lot of assets without having some view on the short term, the medium term, and the longer term. Right now, things look pretty good. On Monday, I said that the yield curve looked about as perfectly priced as you could have it. So does the bond market. It seems to incorporate reasonably good economic activity this year. It seems to incorporate what we think could be disinflationary forces coming from both the headwinds of tariffs on spending and also the impact of AI. It's sort of an ideal market for bonds, including credit.
Well, and to the issue about AI, given AI is so prominent in the equity market, and now AI is also becoming a bigger weight in the public IG index. And by the way, AI is also hugely in venture capital. 2/3 of venture capital is AI. How do you think about the construction of portfolios at the moment when you suddenly have, when you look holistically at asset allocation, one factor, namely AI, that is everywhere?
Well, we've seen a lot of sectors in the past access the markets for a lot of funding. And the lesson from that is to wait until the supply starts to weigh on prices, and that's your opportunity to go in. I think what we do understand is there's an enormous need of capital because there's an enormous productive use for it to build the infrastructure that's going to power everything. What we do see at JP Morgan Chase is every line of business is using AI and how it operates. And it is creating a lot of efficiencies. It allows us to scale very, very efficiently. So it's not going away. It only seems to be accelerating.
Yeah, Bob, I want to build on this. I think it's really important. And I say this a little tongue-in-cheek, but ultimately, a big factor behind the GDP growth for the last 12 months is the capex spend of a handful of companies. Is that becoming the more important macro indicator? Never mind payrolls. It's what happens after the close today from Meta, Microsoft, and what we hear from the big tech players over the next week.
I think so, because they're not only telling us how their businesses look, they're telling us how every other business looks and how every other business is thinking about AI. And are they willing to invest more there? I think we're going to find the answer is yes, that everyone's over the hump. They see this as real. They've lagged a little bit. Why shouldn't they? They were unsure about the impact of tariffs. They were unsure how AI would play out. Now that seems to be in the rearview mirror. I think you are going to see pretty good earnings and pretty good downrange forecasts.
Torsten, this is one of the great dilemmas, I think, for monetary policy makers, officials worldwide right now. The divide between GDP and payrolls growth. GDP is fantastic. Payrolls growth is super subdued, and you can point to supply-side factors like immigration. That's a factor, sure. But the character of GDP is becoming less and less labor-intensive based on what we've seen over the last 12 months.
Absolutely. And a very important point when we talk about the Fed is that also is because we simply have that the forces that are driving GDP are actually not very interest rate sensitive, because most of the forces that are driving the boom in AI and the energy build-out have been coming because of equity valuations being so high. Now there's more in the change in the capital structure towards also more debt issuance. But for the last several years, no matter what the Fed funds rate did, we had a really strong boom in AI. And that was driving the economy forward and continues to drive the economy forward because this strength is coming from sources that are much less interest rate sensitive than traditional components of GDP.
Well, let's get a source on this. Torsten Slot this morning. It was good to see you up before 9 a.m., Torsten. This is his daily note, the Daily Spark. Bob Michael, quantifying the productivity gains from AI. I would say this JP Morgan with, what is it? It's like Walmart, 2 million employees in the U.S. You people have more knowledge, Bob Michael, about the new use of AI. Help Dr. Slack out. How are our productivity gains from AI?
Well, the aspiration is that you're growing and you can do a lot more with the same amount of resource. So that's the ambition and the aspiration. We're still early into it. We'll see what the payback is down the road.
I mean, I look at this, Torsten. Please expand on this productivity, and I guess it comes down to Solo and this strange thing, total factor productivity, which is basically a made-up pixie dust of that like John, you mentioned earlier, that American spirit. What does our total factor American spirit look like right now?
Absolutely. GDP growth can come from three sources: capital, labor, and productivity. And the key issue is if productivity is strong, that can more than dominate the other forces of growth, especially when labor is now contributing less because immigration is being restricted. So that means that the requirements coming from total factor productivity or productivity are really significant because that needs to deliver a lot of growth now that we have less growth coming from the labor side.
This is why it's hard to sell America. So many of these reasons are just a long list of things as to why it's hard to sell America. Bob, the headlines of the last week or so, not just the last week, but the last 12 months, do you push back against them as well, Bob?
Yeah, they're total hogwash. We invest money for loads of different plans around the world. This time last year, into March, April of last year, maybe through the summer, there was some concern. There were plans that were looking at diversifying. We saw very little of it. We're not seeing any of that now. I think there's a realization that the breadth, the depth, the size of the markets in the US make it the best place to exercise your fiduciary duty. And that's what they're seeing. Yeah, is there some currency hedging going on the side? A little bit, but is there a wholesale sell America assets? Absolutely not. If it's happening, we're not seeing it. And we pretty much see everything.
You know, Bob, I'm thinking of University of Pennsylvania, and, you know, you're in Latin class at Pennsylvania where you got straight A's. And, you know, you look at hogwash as Nugget or Frutilla or in Epsia, I'm butchering the pronunciation here, but stay with me on this, Bob. Is there hogwash among the administration? Bob Michael, you're a bond guy. I want you to help me with foreign exchange in Bruce Kasman's world. I got one day it's a weak dollar policy. I got the next day a strong dollar policy. It sounds like it's time for Secretary Diamond.
I think he's doing a great job where he is, and I hope he stays there.
What a way to end an interview. Bob, thank you, sir. Bob Michael of JP Morgan Asset Management, staying out of trouble. Hogwash. That's what he thinks of those headlines.
That's brilliant, and you hear it in your wonderful morning note as well. People are so frustrated by the spin that they're getting, given the cacophony of our American politics and all.
You know, a long time ago, Tom, at the president's first term, Mark Dow wrote a great piece on divorcing your political bias from your market analysis. And I think there are reasons to be worried about diversifying away from the dollar. And I'm not going to color everyone who has that opinion with the same brush, but I will say this. I think some of this has been driven by people who just don't like the policy out of the White House, Torsten. And dare I say they have a bit of TDS. I do think some of that is coloring some of the analysis that's coming from not just Wall Street, but from research desks around the world.
Absolutely. And you go around Europe and you talk to a lot of people who are, of course, saying, oh my God, what's going on? This is confusing. This is chaotic. Institutions, all these discussions. And then you ask at the end of the beer, well, how are you even investing your money? Are we still buying dollar assets? Because dollar assets still offer great returns, again, higher levels of yields. Also in AI exposure, you don't get much AI exposure if you invest only in European stocks. You don't get much AI exposure in Japan, Canada, and Australia. So the US offers things that are simply not being offered by the rest of the world.
I mean, quickly, John, you spent 12 hours on the set in London the day of Brexit here. We're popping 138 on sterling. Does your life change with a 143 sterling?
You're still convinced I get paid in sterling?
I hope so. I mean, I'm looking at the chart here, and we're right up against the range of
given the recent price action, I wish I was funded in sterling, but given this is my 10th year over here, I'm still funded in dollars.
Your review's over.
Okay, thank you, sir. Thank you, boss. Let's get to Diane Swank of KPMG. She joins us now. This news conference starts in about 7 or 8 minutes' time. Diane, welcome to the program. What are your questions for Chairman Powell when this news conference starts?
Well, I think one of the questions that hasn't been asked of the Fed is we've heard the Fed talk about curbs on immigration and its effect on the break-evens on unemployment and the labor market more broadly. We have not heard anything about the pockets of labor shortages that are beginning to creep up. The quit rate in leisure and hospitality absolutely soared in November and over the summer, and that is because of curbs in immigration. We know that foreign-born and native-born workers in some professions, most notably in the service sector, are complements, not substitutes for each other. And that's something that we're watching closely as well. And even with the productivity growth we've seen, the AI boom that's going on is currently, with that productivity growth, not derailed inflation. And in fact, it is adding to inflation on the margin for salient prices for many consumers, notably electricity costs. And then you have this cold spell on top of it that added to natural gas costs. But all of that is still pushing up prices rather than down, where we're going to get a lot of fiscal stimulus in the beginning of the year as well.
Dan, your work recently has been absolutely brilliant about the fabric of employed America. What is the one thing Wall Street consensus, the 3 zip codes in Manhattan, what's the one thing they get wrong about labor America?
Well, first of all, the overall unemployment rate is not really a good summary statistic right now. We know at the end of the year, those having to accept part-time instead of full-time hit an all-time high. We're now at the place where in the new millennium, for the last 25 years, we've seen instead of multiple job holders falling as an expansion goes longer, they're now rising. This is part of that labor share of income being eroded, the inequalities we're seeing out there, and the frozen state of the labor market where those who have a job are clinging on and those who do not have a job are left wanting. I think it's very important to understand when you think about things like the U6 measure of unemployment, which gets into that sort of under the hood. That's running around 8.4%, 2.2% above where it was in 2019. And I think those are important issues.
Very quickly here, the model is that the tech bro are taking over America. We've talked about American exceptionalism, but so many people just want to turn around that ugly labor share vector. How would you do that?
Well, it's a difficult thing to do. And certainly with the way that the C-suite and the gap between employees and the C-suite see AI and how it's affecting productivity growth is another issue. We could literally see a payroll recession as the economy booms in 2026. And that is something that I never expected to see out there. I think it's really important to remember, though, that we still have not ameliorated inflation. We still have inflation. And it's much like compounding stock returns that has driven that wedge of wealth higher. Compounding inflation over the last 5 years has left prices out of reach for too many. At the same time, the labor market is frozen, and that is why you're seeing the consumer attitude surveys we are.
And what are the consequences of the K-shaped situation for the consumer? From a broad macro perspective, the weekly, the monthly retail sales data is still reasonably okay. Does this matter later this year, or how do you think about the K-shaped situation? Is it something that the Fed should take into account, or why does this matter from a macro perspective?
It's really important from a macro perspective because I think it's providing a underlying floor under inflation, and that's what I worry about could happen. That with fiscal stimulus on top of it to temporarily disperse economic gains at the beginning of the year as we see those tax refunds come in, that is important because the sugar high could be very short-lived if it only makes inflation stick. And as I said, inflation's already compounded to the place where most Americans feel that things are out of reach. And that underscores and undercuts the Fed's inflation-fighting credibility.
Dan, I think we have to say, and I'm sure you share this sentiment, if any of us gets a tax refund, it's paying the energy bill over the last month. Dan, thank you. Dan Swonk weighing in on the Federal Reserve and a backdrop for the economy. I think we just take a beat. With the 2.5 minutes we have left, what Dan Swonk just said there, that we can have an economic boom and a payrolls recession. Now, I know this sounds a little bit philosophical, but what on earth is a boom if we have a payrolls recession?
I'm going to go to Torsten. I think your question, John, is brilliant. What she said was remarkable. I don't think I've ever heard that, ever. The bottom line is we have a president who's prosecuting a neo-mercantilist strategy. You were weaned on this ages and ages, great-grandpa Slock 1,000,000 years ago as well. How do we extract ourselves from a neo-mercantilist strategy to get growth back in for the rest of the public not benefiting from this tech boom?
Well, the challenge, of course, is that the AI boom has been the main driver for so long. But if you implement policies, of course, that ultimately says that we want fewer goods and fewer people to come into the country, the risk is that, of course, does come deglobalization with a risk of higher inflation in prices, risk of higher inflation in wages. So that's why this is not only the US, this is also Europe, this is also across the OECD area. You're seeing more and more segmentation of the global economy. Of course, results in now everything needs to be produced domestically, home shoring, onshoring, reshoring. All that, of course, results for fixed income investors in more upside risk to inflation.
Did you just describe the 1930s in the United Kingdom?
Tom, the biggest risk to the GDP growth we've discussed over the last 12 months are the populist remedies the White House might introduce to try and correct the K. One of those issues we've talked about for the last few months, the last month or so, has been the introduction of a cap on interest rates on credit cards. That could have the complete opposite intended effect of chilling financial conditions, of tightening credit availability. And they're the kind of things that at the moment, this administration, TK, they're the kind of things they're thinking about.
I think the phrase is grasping at straws. I don't hear much policy or science behind it. Maybe we'll hear that in these comments.
Torsten, this just in from Hugh Van Steenis of Oliver Wyman. I'm sure you know him. He wants us to start a podcast. I want to know if Mark Rowan will give up Torsten once a week so we can do a little podcast together. He likes the last hour so much.
First guest could be Hugh Van Steenis.
Do you think Mark and Jim will get on board with that? Can we have you once a week? Can you write the check? Have we got a budget in the surveillance?
Yeah, I can work it out.
We'll try and make that happen. Torsten, this was a pleasure. Thank you, sir.
Thank you.
Torsten Slock there of Apollo. This could be a snoozer over the next 60 minutes. The last 60 minutes has been anything but. Equities right now, very close to all-time.
Okay, guys, it's time. Powell has came. So let's listen carefully.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. Since last September, we've lowered our policy rate 75 basis points, or 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariff increases have passed through. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to ask that, you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with, I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought it might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply it used to say that judges that downside risks to employment rose in recent months. So we saw data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling, and so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting, and that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timrose, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today I'm simply going to refer you to the statement that I made on January 11th. I'm not going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today, and some ancillary areas. But I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Mike.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? If so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today. That either.
Why would you want to leave it all under the circumstances?
Again, I don't want to get into this. It's not something I'm. There's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. And another one that might, lead to a similar answer. we've seen quite big movements in the dollar over recent days. What do you think is driving the US currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency, and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
I mean, what's your view on the market movements? I mean, what do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Yeah.
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market and the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the beige book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing,
so we haven't made. What we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve.
Steve Leisman, CNBC, and sticking with questions you might answer. Thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the S&P and the longer run rate, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. I mean, maybe I missed by 1, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy's significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course, no one knows with any precision. If you had a follow up,
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the SEP from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Amira.
Thank you, Chair Powell. Mara Moakley from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people didn't want to cut and dissented, but the committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to have probably both diminished a bit. So we'll be looking at that. It's about how you weigh the risks to the two goals and how big those and quantify them. And so there are different views on the committee, and we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2% x the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the mandate as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy's in a good place. I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, you a minute ago you said you felt expectations were consistent with your mandate. That the 2 and the 10-year break evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
Andrew.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
We haven't made. You're right. We saw the labor market weakening, and we acted. And I think that's the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think that the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments too on inflation now.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now. Anybody's base case that the next move will be a rate hike. But ultimately we'll do what we think is the right thing. But that's not where people's expectations are right now.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
Over time, you've seen that U.S. rates have remained they haven't moved a lot really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But right now we're running a very large deficit at essentially full employment. And so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with. And that, in the end game, that's where you wind up, because it's some kind of a difficult thing. But that's not where we are. It's not where Japan is either. But it's certainly not where we are right now.
Does it reduce the effect of your rate cuts that longer-term rates have overall not really budged that much?
I wouldn't say that. The thing is, technically, higher longer-term rates means less accommodative financial conditions. But remember, many things move longer-term rates. It's not mostly what happens on the short end. There can be effects of longer-term rates from moving our policy around, but it's much more assessments of the fiscal path and fiscal policies and risks and things like that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between 10-year rates and the overnight rate.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Republican Senator Tom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that is served the people well, and that is to have a separation between to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile. So I'm not talking about the U.S. context. This is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, first of all, it would be hard to restore the credibility of the institution if people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Archie.
Archie Hall from The Economist. On that sort of stabilization of the labour market question, how much do you see the weakening we saw in the past 6 months, a year, as a kind of data mirage around immigration, the government shutdown and so on, that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labour market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But, it shows, it's a survey showing that workers feel like job availability it's a very low reading. It's just one reading, but it's an indication of softening. People, part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, I could go on and on, there are lots of little places that suggest that the labor market has softened. But you're right, part of payroll job softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. So imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in balance, that you could say that's full employment. At the same time, do we really feel like that's a maximum employment economy? It's very challenging and quite unusual situation.
Thanks. And then one more on growth and the kind of strong growth outlook, or strengthening growth outlook you're now seeing. How much of that is the fiscal stimulus we're seeing from the beautiful bill, the tax cuts, and all of that?
So you're seeing it already. You don't have much of the fiscal. I think the outlook, you're right. It's financial conditions and it's fiscal policy for 26. But you've got strong consumption that's been happening before financial conditions have been supported, but before the fiscal effects really are shown. So essentially the economy has once again surprised us with its strength, not for the first time. And consumer spending, although it's uneven across income categories, but consumer spending overall numbers are good, and we're benefiting from the AI build out of data centers. That's another thing we're benefiting from. But the economy overall, the growth is on a solid footing. It looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven. The president calls inflation defeated and solved. The FOMC says it's a somewhat elevated inflation. But you talked about those customer survey or those consumer sentiment surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues about how wealthier consumers seem to be driving so much of the economy, and why so many families still feel like they just can't make ends meet after 5 years of rising prices? What is that discussion like?
So a couple things. One, there's something to it in that we know that higher income households that tend to own real estate and tend to own stocks, securities, and those assets have been going up in value, and increases in wealth do support spending over time. So, and that's clearly a part of the story. We also know that for some time now, for a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands, and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and that is a reality of what we're seeing. They're still consuming, but they're feeling it in a different way. I would say more broadly on affordability, we have a vast network through the reserve banks and also through the board of governors, where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart, because one of our jobs is price stability, and so the best thing we can do for people who are feeling that squeeze is to keep inflation under control, and frankly, to finish the job of getting inflation back down to 2%.
You mentioned the AI build out as being a positive for economic growth this year. I wonder, as you look at the weakest year last year for job creation of a non-recession year since like 2003, are you concerned about AI maybe supplanting more entry-level work and entry-level jobs, and how does that play into what you're watching about the labor market?
So everyone, of course, is watching AI and the deployment, and trying to understand exactly what's happening. And there's a wide range of possibilities. It's hard to say. And of course, anyone who uses it is amazed at what it can accomplish, right? So every technological wave will eliminate some jobs and create other jobs. And it's always been the case. If you look back, wave after wave after wave, there will be some disruption, but ultimately technology increases productivity, which is the basis for rising wages. And it may not all happen immediately, but over time, it's what enables incomes to rise over time, is rising productivity. So we always ask, well, this is going to be different. Is it going to be different? And we don't know. And we may, in any case, see in the short term jobs that are being eliminated by the capabilities of AI. We may see that. We just don't know what the overall effect is going to be. So how to think about it in macroeconomic terms, it's very hard. We can look at the aggregate data. We can analyze, for example, there is some connection, it appears, between the low hiring rate for recent college grads and AI, but it's not the main or only driver. You hear large companies, though, many of them saying that they either won't be hiring for some time, or that they're hiring less, or that they're laying people off, and they tend to refer to AI when they do that. So we're all watching and learning, and it could certainly have pretty significant effects on the economy, the workforce, and our society. we don't really have the tools to address the concerns that may arise, but we have a lot of people who focus on analyzing it and try to understand what the macroeconomic implications are, which is our job.
Thank you.
Thank you, Chair Powell. Bei from AFP News Agency. You mentioned earlier that on inflation, the broad expectation was for a one-time price increase and then for inflation to come down. And I was wondering, is your expectation still for inflation to start cooling in the second half of 2026? And if you could elaborate how far we are from target currently. Thank you.
So how far we are from target is, as I mentioned in my opening remarks, we had 3.0% core PCE inflation over the 12 months ending in December. And that's pretty much what we had the year before. So on net, no progress. But the story behind that is modestly positive in that most of the overshoot was in goods prices, which we think is related to tariffs. And ultimately, we think those will not result in inflation as opposed to a one-time price increase. Okay, so that's where it is. In terms of, you asked, no one thinks they will, ex ante understand really clearly, precisely when this will happen. But there's an expectation that sometime in the middle quarters of the year, we'll see tariff inflation topping out. So what we do is when a tariff is put in place, we track the effect of those tariffs over a 6, 7, 8, 9 month period. And you can see for that tariff, how long it takes to reach a place where it's affected the price level, and that's it. So we're getting better at that. And our estimate is that it'll be sometime in the middle of the year, but I wouldn't look for great precision in that. But, we'll be able to see whether things are moving in that direction. I think, we will be able to see.
Richard Escobedo.
Thanks, Chair Powell. I'm Richard Escobedo with CBS News. I want to look outside the U.S. about what's happening outside our shores and how it impacts the U.S. Canada's Prime Minister said last week that there's been a rupture in the global order, and I wonder how you're thinking about geopolitical risk as it relates to the U.S. economy.
So I can't comment on that speech or statement or anything like that. Geopolitical risk for us a lot of it is around energy, oil. And so far we haven't, for all the turmoil, oil prices have come down, as you know, and so we don't really see much. Longer than that, it's trade, and the trade, our economy has pulled through pretty well, you'd have to say, given the very significant changes in trade policy. The U.S. economy has pushed right through. Partly that is that the way that what was implemented was significantly less than what was announced at the beginning. In addition, other countries didn't retaliate, and in addition, a good part of it hasn't been passed through to consumers yet. It's being taken by companies that stand between the consumer and the exporter. So that's where that is.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With third quarter GDP growing at 4.4% and the fourth quarter expected to have a 5 handle on it as to what the Atlanta Fed is predicting, at a time when you had a government shutdown and we thought that was going to shave off some growth. You've also got the fiscal tailwinds you've talked about, big tax refunds coming, potential tariff dividend. How could you cut rates and not spur inflation in that environment?
Well, we didn't cut rates today, but it would depend. It depends on how fast potential output is growing, right? I'm just asking in principle. I'm not saying this is what's happening, but there's growth and there's how fast the potential is growing, and at a time of high productivity growth, potential output is rising. So it really matters whether potential output is growing as fast as actual output, and it would matter over time. The numbers you cite were for quarters, and quarterly GDP is you need to look at 12 months because quarterly GDP can be very lumpy. GDP was negative in the first quarter last year, so the overall over the year the numbers were nothing like that. It was more in the mid 2s for the year.
And how do you explain the divide right now between strong economic growth and the job market? Is it productivity that's filling the gap? And is productivity being driven by AI at this point?
So there has been, you're right, there has been a divide of solid growth, but would look like a weakening labor market. And that can be explained by rising productivity. But I would say we do see signs of certainly of the unemployment rate stabilizing. So it may be we're seeing the beginning of the resolution of those two things. Also, as you probably know, the lore is that when GDP and the labor market get into an argument, in the end, the labor market data is more reliable. GDP data is very hard to collect and understand, but nonetheless, I think we may be seeing that tension resolving a little bit. Too soon to say with any confidence, though.
Matt Egan.
Matt Egan with CNN. Chair Powell, after today, you have 2 meetings left as Fed chair. You've obviously experienced a lot during your time as Fed chair, served under multiple presidents. I'm wondering what advice you have for whoever your successor might be.
Honestly, I'd say a couple of things. One is stay out of elected politics. Don't get pulled into elected politics. Don't do it. And that's another thing. Well, another is our window into democratic accountability is Congress. And it's not a passive burden for us to go to Congress and talk to people. It's an affirmative, regular obligation. If you want democratic legitimacy, you earn it by your interactions with our elected overseers. And so it's something you need to work hard at, and I have worked hard at it. So, and the last thing is, it's easy to criticize government institutions so many ways. I will tell whoever it is, you're about to meet the most qualified group of people you not only have ever worked with, you will ever work with. And when you meet Fed staff, and not everybody's perfect, but there isn't a better cadre of professionals more dedicated to the public well-being than work at the Fed.
Thanks for that answer. If I may follow up, as I'm sure you've noticed, gold and silver prices have experienced historic gains of late. And I'm wondering how much attention, if any, you pay to those moves and what message you may take from these significant price increases we've seen for precious metals.
Don't take much message macroeconomically. The argument can be made that we're losing credibility or something. It's simply not the case. If you look at where inflation expectations are, our credibility is right where it needs to be. So we look at those things. We don't get spun up over particular asset price changes, although we do monitor them, of course.
Nicole, for the last question.
Hi, Nicole Goodkind Barron's. Some prominent critics have charged that the Fed's economic models are somewhat backward-looking, but should be more forward-looking, incorporating things like productivity increases from AI. How do you incorporate current and future developments into your analysis and decision-making, and do you have an answer to those critics?
Yeah, so by and large, those criticisms, as somebody on the inside, they just don't make sense, and I'll tell you why. Every FOMC participant writes down a forecast every quarter, right? The summary of economic projections. And that's the basis for how we think about the economy. So the other thing is, what an economic model can do is it can grind up all the data for the last number of years, 50 years, let's say, and it can identify what are the relationships between variables A, B, C, D, and all that kind of thing. And it can tell you if you change one of those variables, this is what should happen in the macroeconomy. That's just the way it works. However, the structure of the macroeconomy is constantly changing. For example, we hadn't had a pandemic in 100 years. It wasn't in the model. And we knew it from the very beginning. It was not in the model. A trade war of this scope, we'd never had that in 100 years. And so there's great uncertainty at different points. thing I'll say is, when it comes to, technological developments that raise potential output, some kind of technological revolution, like happened in the 90s here and like maybe happening now with AI. We're all over that. And, everyone studies those periods, and, we're very clear-eyed about the possibility that this higher productivity may persist. And also that it may not. We're not, no one's sitting here unaware of the possibility of higher productivity. We've been talking about it for 3 years. It long predates the current situation. It's been going on for 5 or 6 years. We've had productivity higher. We've been talking about it that whole time. So it's very much on our minds, and we are well aware that higher productivity means higher potential output, and it changes the way you think about potentially inflation, growth, labor market, and all those things. That's all in our models. I mean, if it's just a question of using better models, bring them on. Where are they? We'll take them. But I think, we certainly are in contact with anybody who does economic modeling, and we're always looking to do better at that. But that's how I think about that.
And just a quick follow-up. We've been talking a lot about tariffs and passing through, and we've been talking a lot about them for the past few months. The trade landscape is still in a constant state of flux. Announcements, threats, negotiations, they're all frequently changing. So I'm wondering how you actually track these, what data or channels are most critical to follow this in real time?
Trade?
Yeah, the impact of tariffs and how they're changing.
Yeah, I think our staff has done a really nice job on that, and they've kind of put it together in real time. So as I mentioned, a tariff gets put in place, you can pretty much track its effects on pricing and on everything. And so you build a model up from all of the tariffs. At the beginning, it was very much of a forecast. Now it's every cycle that goes by, it becomes more informed by actual data. And our forecasts were not far off. What changed was, as I think I said earlier, what was implemented was smaller than what was announced. In addition, we didn't see retaliation internationally, and I think people did generally expect that because we saw that in the past, and that really mattered too. And then the other thing is that pass-through didn't know how fast that was going to be to consumers, didn't know how much exporters would take, how much companies in the middle would take, and how much the consumer would take. And it turns out it's a lot of companies in the middle who, by the way, are pretty strongly committed to passing the rest of it through, which is one of the reasons why we need to keep our eye on inflation and not declare victory prematurely.
Thank you.
We're done?
We're done.
Okay. Thank you very much.
The chairman of the Federal Reserve. That did not sound like a skip.
All right, guys. Such a restless Powell today. A truly boring and pointless speech. So Powell say that the economy is holding up, the labor market is healthy, and unemployment has stabilized. Inflation is above the target, the core inflation, and monetary policy and decisions will continue to made meeting by meeting and based on future data. Interviewers have tried to push Powell to answer on the debate with Trump, but he didn't.
He's a wise man,
Yeah. It seemed clear that Fed won't be cutting rates anytime soon. Also, with Trump's new tariff announcement, the dollar index dump and bond markets selling, and another possible shutdown could be on the surface. So uncertainty also seems to be growing from here. Bitcoin is showing a reaction on the fair value gap here at 89K. Target remains the 91K. So that's it for the special live today. Dimitro, you want to end up with some comments on Powell, whatever you want?
Yeah, it was really interesting. I noticed one interesting thing that sometimes Powell, when interviewer have some maybe uncomfortable question for him. He said like, I do not have nothing for you today, and just moved to another interviewer. That was really interesting. And I heard it like several times, like 3 or 4 times, you know. So yeah, you were right.
So
That was like pointless speech. I mean, he just tried to avoid like all uncomfortable questions, you know, and that was really weird, I would say.
yeah, so restless. Yeah, he avoid like 50% of the first interviewer questions. So
Yeah.
yeah, it was funny. It was funny.
Yeah, but nothing major on the market, and I mean,
Yeah.
yeah. We're
and
really
as-
happy that crypto didn't like crash. Yeah. So
yeah,
that's
yeah,
great.
yeah. I think because we are already at the minimal bottom on crypto,
Yeah.
so it's very hard to go lower. And as crypto buzz just comment, stay strong to the moon.
Yeah. By the way, Rafa, for the end of the stream, can we check the low volume profile? Because I mean, really interesting this fair value gap. Seems like we have so much orders there. Because yeah, I mean, there's a really powerful level. Let's see that.
Let's see. You want to change? Okay, sorry.
No, it's okay. It's okay. Let's see. 15 minutes. I mean, okay, we don't have that.
Let me reduce it a bit. Okay, yeah. Volume are concentrated here on 87K and on the current price 89. So, yeah.
Okay. Yeah, that was really interesting. Okay, so I think we can finish this special live. Yeah, that was really interesting, and yeah.
Yeah, no big surprise. So let's see next time. And thanks, Dimitro. Thanks, everyone. See you tomorrow with the scalping session.
Yeah, see you, everyone. Bye.
Bye.